Good afternoon and welcome to You and Your Business with me, Alec, on 103.2 Dublin City FM. Each week, I invite an expert from the world of business to share their knowledge, insights, and tips to help you with your business challenges. If there's a topic you would like discussed, or if you feel you can make a contribution, please email me at yourbusiness@dublincityfm.ie, and perhaps we will be having a chat here one day soon. And my guest today is the Managing Director of Pure Finance. He focuses on building and protecting wealth. And he, on top of all that, he enjoys surfing. Delighted to welcome Eoin Wilson to the You and Your Business studio. Hi, Eoin.
Hi, Alec.
Yeah, great to have you here. As you know, I'm probably going to take you back to your last year in school. I mean, were you the academic? Were you the person who wanted to get into the workforce? Do you want to travel, or had you anything on your mind that you really kind of floated your boat, as they say?
I was hardworking. I was a bit of an academic. I guess my main aim was to get enough leaving cert points to get into UCD or Trinity. I did get enough points to do a degree in UCD, did an arts degree specializing in economics, but I didn't actually really know what I wanted to work as from a career perspective.
Yeah, and I think that's quite common for a lot of people there. I mean, I think arts is often a sort of standby place for people to mark time at, but you're also sort of interested in finance or economics, weren't you?
Yeah, I mean, I remember during our breaks at lunchtime in school and coffee breaks, guys talking about economics, and I was always had a keen interest in it, even though I wasn't studying it in school. I just thought it was a very interesting topic.
And were you thinking about it from an economist point of view, as in sort of the macro picture, or were you sort of more focused in your interests somewhere else?
Yeah, no, it was an interest in, how does something affect the economy? So like why do interest rates impact the economy? With the increased cost of borrowing, how does that impact a business? So I guess the nuances of economics and how they interact with the economy, and how central banks can intervene and push the economy one way or the other. I found that very interesting from a young age, even though I wasn't studying it.
Yeah. All right. So I presume you went on to get your degree.
Yeah. No, I was it was a rude awakening going to college, Alec, because I was in boarding school and then went to college, and the shackles were off.
Yeah. Welcome to the wide world.
But yeah, no, I did a degree in economics, and I suppose first year I wasn't working very hard, but it was the second and third year I pulled up the socks a bit.
Yeah, that sounds par for the course. All right. First year is party year, and then after that, you kind of get burnt out a bit from it. All right, so you got involved from the economic side of it. Okay, so you finished your degree. What are you going to do? Did you go on to do further studying, or did you go out into the workplace?
So my first job, I actually worked for my uncle. He has a drinks company, Mickey Finn, and Agua de Bolivia. So I was involved on the marketing side and the sales side. So I worked there for 6 months, and then I had an opportunity to work in Ulster Bank. So I worked in Ulster Bank for 3 years, and this was between 2004 2006, and mortgages. Everyone was getting a mortgage, second mortgage, and a third mortgage.
Yeah.
So I was on the operations side in Ulster Bank. So I enjoyed that.
Yeah, I mean, there were certainly heady days in terms of lending. I mean, I'm from a banking background myself, and I suppose when I was in banking, mortgage interest rates were about 16%. But it's sort of the shackles were off in terms of mortgage lending back in those days. It must have been very easy to give out mortgages.
Yeah, I think it was a crazy period. I remember, I was just on the administration side, and
sure,
they were doing in Ulster Bank in Sandyford, they must have been doing, I don't know, 30, 40, 50 mortgages a day, or it was just a crazy time. And people were making a lot of money, in that space, but wasn't myself. But yeah, no, it was an interesting time.
Yeah, it certainly was. I mean, it's interesting to kind of reflect back on them now, especially with your interest in economics and that to look back on those days. And the warning signs were all out there, except nobody was paying any attention to them. You know,
Yeah, it's like running a tap, thinking the water will just keep on flowing forever and ever, and
That's it.
eventually stops,
Or the bill comes.
or the bill comes. Yeah, exactly.
Yeah. Okay. So it was an interesting time working in sort of retail banking. So you spent about 3 years there. What was going to come next in your life?
It was interesting. I mean, I do remember, or I reflect on my time there, and I remember chatting to a few other guys in the mortgage side in Ulster Bank, and we were saying, wouldn't it be great to set up a mortgage broker
Hmm.
together, and why don't we do it? Anyway, none of us had the courage at the time to do it, but I decided at that point I'd like to work on the other side, maybe working for a broker, and I just kind of felt I was getting a bit stale, and I just wanted a bit
Sure.
more excitement and dealing with customers directly. And I eventually wanted to get into the sales side, so that's what I did. I moved to a brokerage. I started in the administration side, and then eventually moved up to become a financial advisor.
It's amazing. I mean, again, as I said, my time in the bank was in much earlier days, but I kind of think that the regulation back then was far less onerous than it has become. Back in the days that you're talking about, I'm sure there were some regulations, but I presume they're nothing like the sort of draconian measures that are out there today.
Oh yeah, no, back in those days, I do remember mortgages flying out. All the various banks coming in, and providing lending at a very, I suppose, unonerous level.
Hmm.
Like without a lot of paperwork. If and even if you were on quite a modest income, you could borrow quite a lot. So I guess interest rates were quite low then. You had the
Yeah.
tracker rates, and banks were just super hungry to lend, which we've all learned our lesson. We're still paying for those mortgages,
We, we certainly
or
are.
or Ireland is certainly paying for it anyway.
Yeah, I suppose, I mean, if you take back to those days in terms of from the brokerage side, it must have been very easy to match up clients with banks who were providing funds.
Yeah, I mean, I remember Bank of Scotland, offering mortgages less than, I think it was 0.6, 0.7 tracker rates.
Wow.
And there was no, the ECB was very low at the time as well. And, banks were just super hungry. Self-employed people could self-certify their income back in those days. They I'm Owen, I'm earning 70 grand a year, 100 grand a year.
Hmm.
The banks believed you. So, but that's what led to the crash as well. So, and now we're probably on the side of a very difficult period for mortgages where it's very onerous to get a mortgage, and it's very strict.
Yeah, it certainly is. And if you're just joining us now, you're listening to You and Your Business with me, Alec Drew, on 103.2 Dublin City FM, where my guest today is Owen Wilson from Pure Finance. Just talking about, so you got managed through the whole Celtic Tiger into the the bad side of things. How was the brokerage world then? I mean, there must have been much fewer mortgages being applied for, and what were the sort of pillar banks doing back then?
Yeah, I suppose when I was working in a brokerage, I was on the kind of mortgage admin side, and then I moved. I was pushing for a sales position or a financial advisor position, and I was moved into a pension, life insurance advisory role.
All
Um,
right.
and yeah, I remember pensions had dropped by 20 or 30% back in 2008. So it was an interesting period where um, no one wanted to invest, Alec, and no one wanted
Sure.
to set up a pension,
Yeah.
and no one had money. So I mean, that was definitely. I probably couldn't have started my financial advisor job at a more difficult time um, in
So tell
2008.
me again, this is one of the sort of insights people get. So you're in business, so you have to make it work for you. Have you any sort of thoughts or tips you might have for our audience? Just how you managed your way through all of that.
Just hunger and perseverance were the key. I mean, I remember calling, I won't name the shop, but like they had a retail franchise, and I had a list of 100 people, and I just tried to set up a meeting with them. I had
Sure.
100 people on the list, and I might have a meeting with 10, and then eventually, 3 or 4 people might actually do business with you. So I mean, it's just a numbers game, really. That's my best piece of advice from a businessman.
And don't take rejection personally.
Yeah, don't take rejection personally. I remember, oh, I'm really bad with directions, and we didn't have GPSs at the time, and I had to go to a shop. I got lost, and I was like an hour and a half late. It was horrendous, and the guy made me wait an hour and a half to meet him when I was in the shop, and then he taught me a really big lesson because I've never been late again for a meeting. But he's like, "Okay, we'll meet for 5 minutes. We'll have a coffee, but I'm not going to do any business with you."
Well, again, these are the lessons you learn and you take with you for the rest of
Yeah,
your life.
yeah. So I'll never become a taxi driver, Alec, because my sense of direction is horrendous.
Well, all I can guarantee you is using even GPS these days, the one thing you can be guaranteed is you will find yourself in a cul-de-sac at some stage.
Yeah, no, that's true. No, Google Maps was a savior for me. That's for sure.
Well, it's a bit like finance. I think you will find yourself in a cul-de-sac sometime.
That's true.
Okay, so you were more interested in the whole area of pensions and protecting wealth. So the business starts building up, but then of course the regulations start kicking in as well. Tell us about how you navigated your way through all of that.
Yeah, I suppose the regulation is getting harder and stricter all the time, and it's just I suppose the way I see regulation is, if I was investing for my dad or my brother, or myself, would I put this client into that investment? Equally, would I do the same thing for someone that's really close to me? And I think if you're doing the right thing for the customer, it's very hard for the regulator to say, "Oh, you did the wrong thing," when you're really trying to do the best thing depending on their circumstances. So I think that's helped me over the last 15 years. So yeah, thankfully, touch wood, I'm okay with the regulator.
You might explain to our listeners two things here, because I mean, not everybody is 100% regulated, so there are some schemes out there that people should be watching. But if we were to talk about two areas, you might just talk about the difference. One being a tied agent versus an agent that's not tied.
Yeah, I suppose there's kind of two questions in there. So yeah, I suppose the first one is, a lot of customers are unaware that financial advisors can sell regulated investments, which are covered by the central bank regulatory process, and then unregulated investments. And over the last maybe 2 or 3 years, there have been a lot of unregulated investments that have gone under. Unfortunately, Dolphins Trust being one. And then there's a couple of others that are, finding it difficult. So people can lose 100% of their money. So it's important to be just aware of that and be careful when you're investing your money, especially if it's unregulated. I don't believe in unregulated investments, and I don't recommend them. But then back to your question on, sorry, what's your second question there?
We were talking about tied versus non-tied agents.
Oh, tied versus non-tied. Yeah, there are a lot of advisors out there that are tied, and then there's quite a few that are untied. So untied, they deal with all the insurance companies. So Royal London might offer a discount of 20% on their life insurance. Standard Life, for example, are offering good deposit investments right now. So I guess I would recommend, if someone's looking for an advisor, to go to a broker that has agencies with all the insurance companies. You just have more of a mix to choose from, rather than one insurance company.
Do agents have to declare if they are tied to a particular insurance product?
Yeah. I mean, it should be on their terms of business, who they have an agency with, and if it's just one company, it should be on the terms of business. Yeah.
I know that this whole area of the market has been sort of very well regulated in more recent times. So there's, again, I think people who are investing in pensions are taken through a sort of profiling, that it's a self-completion profiling. Is that correct?
Yeah, I suppose there's a couple of things there. So there would be profiling, and I guess the risk profiling would be a key one. What's their attitude towards risk? If they lose 5% of their money or 10%, 20%, how do they feel? That's an interesting one. How do you feel if your pension drops by 50%? I've never really had a customer that feels okay with that.
Yeah, I can understand that, all right.
So yeah, there is a process to, I suppose, understand the sort of risk that someone might want to take, and then also other questions on, how much do they want to budget for, and how much do they want in the end, which is a really important question. How much you want to actually retire with, or how much do you think you need when you come to retirement?
Let's just talk about that for a minute. And again, I'm throwing you out here, so you can say I can't answer it off the top of your head. But let's say somebody is on 100,000 a year now as an income, and let's say they're 30 years of age. What sort of contributions do they need to start making into a pension fund to have some realistic expectation of that plus inflation going forward? You don't have to tie down numbers, but what percentage of their income should they be putting away?
Yeah. Yeah, no, I sometimes do like to tie it down to numbers, but if they're on 100 grand, they're getting taxed heavily. So I generally think someone in their 30s should be putting at least 500 or a couple of €100 into their pension. There's 100 euros or even 200 euros is not going to make a big difference to your overall pension when you hit retirement age. So you need to be breaking that 500 euro mark, I think, in your 30s to have a good pension. I also think a good barometer or a good kind of target is to try to achieve 100K in your pension by the age of 40.
All right.
Yeah. And then in your 40s and 50s, trying to hit a higher level, 700 or 1,000 into the pension. But you have to remember, if you're paying in 500 into your pension in your 30s, it's costing you nearly half, because most of it's tax free. 40% of it's tax free. So it's going to cost you around 300 euros. Which is
all right. So I mean, realistically, then somebody putting in, let's call it 800, it's going to cost them, say, 500, which is about $6,000 a year. It's only 6% of their gross income to put into a fund, which would meet the criteria, I presume, over a 10-year period of achieving that 100,000 you're talking about by the time they get to 40.
Yeah. And I also think, a good barometer is to try to achieve 2/3 of your income come retirement age. That's kind of generally a barometer. So if someone's earning 100 grand, they should probably try to hit 60 grand in their pension, 66, combined with the state pension.
And if you just join us now, you're listening to You and Your Business with me, Alec Drew, on 103.2 Dublin City FM, where my guest today is Eoin Wilson, and we're just talking about pensions. So you're aiming for 2/3, and of course you're going to have to build in inflation. We would have liked to have thought if inflation would have stayed the way it was about 4 or 5 years ago, but unfortunately we were seeing that change. What are we up around about 6% or 8% at the moment?
Yeah, I mean, inflation is very high. So people have to remember, if you have 100 grand sitting on cash, that's depleting. That 100 grand is probably worth 93, 92 now,
Yeah.
So it's, I think a big one with pensions as well, Alec, is making sure that people are taking enough risk, good, smart, I like to call it smart risk in their early years. Someone might say, I don't want to take any risk on my pension, in their 30s. And I've come across people that are in their 30s. They were investing in cash. So they were earning zero in their pension.
Yes.
But they should be investing in the best companies of the world. The best companies all around the world try to achieve 7 to 10% a year to have that growth. Because that's the other big thing about pensions is the investment growth is tax free. So if you're getting that compound interest every year, it's going to make a big difference to your pension.
Right. It's tax free until you go to withdraw it, of course.
It's well, you can get up to a quarter tax free, so you can get up to 200 grand tax free. So yeah, until you withdraw it. But yes, I mean, you are taxed on any withdrawals, income tax.
Yeah, so, I mean, really what we're talking about here is as sort of good advice for people is this. If you're young, you need a reasonable risk profile because, again, like cash will return nothing. So that's the very safe side, but unfortunately, inflation will eat into it. Whereas, again, I suppose what we'd call a balanced portfolio of investments will have some quite risky things, but it'll be, sorted out with less risky things. So there's a good mix in a good portfolio.
Yeah, I mean, if I was to try to talk to a 20-year-old nowadays, I would ask them, do you think investing in Amazon, Facebook, Coca-Cola, McDonald's, if you take the top 100 companies worldwide, do you think they'll be in a better position in 20 years' time than they are now? And plus all the new companies that'll come into the stock market. And over the last 100 years, the stock market has done close to 10% a year. So, and I think, unfortunately, since the recession, people are taking a lot less risk,
right,
when it comes to investing, and they're not getting the returns. So that's a big problem in the industry. A lot of advisors are saying that, oh, maybe you should go low risk. There's less repercussions on me if anything goes under. But
sure.
Equally, they're missing out on the good returns out there. So it's yeah, I mean it's a learning, Alec. It's a learning.
Yeah, I mean, if everybody knew what to do, we'd all be millionaires. But that's the problem. Tell me, what have you any sort of view on cryptocurrency or precious metals?
I avoid cryptocurrency. Yeah, and the big reason is I don't fully understand it. I can't get my head around it. So I don't recommend it for clients. It's also extremely volatile, but I mean, the main reason is I just can't fully get my head around it. Precious metals, gold tends to do well when the stock market goes under. But I think the best piece of advice I can give for people if they want to, and my sister likes to call it, making money while you sleep, is to invest in a passive fund where you're investing in companies around the world.
Right.
So, that's proven to be a very good way of generating wealth.
Yeah. So a diverse portfolio. Can I say I'm delighted to hear that you're not afraid to admit that you haven't a clue about crypto. I keep saying the same, and nobody's ever been able to explain it to me in a way I understand. So I steer a million miles away from it.
I'm sorry to disappoint you today, Alec. I couldn't explain it.
No, you couldn't. You couldn't explain it because I done many people who come up to me and seem to be quite bullish about, oh, this is brilliant. And I asked them to explain it, and they can't explain it. And they drop into the old jargon that we all hear about, and it doesn't make sense. So when it doesn't make sense, I won't put money into it. That's my piece of advice to people if they're thinking of investing out there. Do that. And the precious metals thing too. I'd have a bit more knowledge about that, and it's a bit more stable. In terms of, have you any advice for people who might be in their 50s who mightn't have a substantial income, but also are very short on pension?
Yeah, so I had an interesting conversation with a farmer not too long ago, and he's like, "I don't believe in pensions, Owen." And his wife was telling me, "Oh, get my partner to invest in a pension." And he said, "Owen, just bring it down to nuts and bolts and tell me, what is the minimum amount I should maybe focus on within a pension?" And for people that don't have a pension, 100 grand is a good amount to think about. Because a lot of people don't realize that you can earn 18 grand a year tax-free at 65. So the state pension's around 13 grand, okay?
Yeah.
So if you had 100 grand in a pension, it would give you, give or take, 5 grand a year. So trying to just even the minimum amount that people maybe should focus on is, consider trying to build up a fund of 100 grand. It could be worthwhile. Or it should be worthwhile by the time they hit 65, because it's all tax-free.
Yeah, and there is a lot of advantages to this whole tax issue. again, you're probably talking to people who would be directors of companies, apropos those who are individuals, and there's different tax advantages.
Yeah, I suppose directors of companies have, I suppose, a lot of flexibility, and that they don't have a limit as to how much they can pay into a pension at the moment. The rules changed at the end of last year with PRSAs, so there's no limit to how much you can pay into a pension now, whereas employees are restricted to the age-related limits. So it's an interesting dynamic where directors have a lot more freedom.
So would I be correct in assuming if you were on 450,000 a year and you decided to take 150,000 of that as a salary and pay 300,000 into a pension fund, potentially you could be paying nothing in income tax?
Well, as you said before, Alec, I mean, you could throw that into the pension. You can't pay it more than 2 million, or it's 2.15 million into a pension pot overall. But yeah, if you throw it into a pension, there's no income tax, but you will get taxed on the way out when you draw
Yes,
it.
of course.
Yeah.
But it's just an interesting thing for people to think about, that if you have surplus money, if you put it into a pension fund, you are saving somewhere around 40% in your income tax bill.
Yeah. I mean, and another good, I mean, I like to just bring it back to nuts and bolts. Like, if you have a director and he's like 61, he's got 100 grand in his business, he could drop 100 grand into a pension, right?
Yeah.
Or if he paid 100 grand as a salary, he'd get around 50. But he throws in 100 grand into a pension. The next year he takes 25 grand out tax free, because you're allowed a quarter. And then that 75 grand would be taxed income tax. So he would be up considerable amount, you know what I mean? When you compare the two.
Well, I suppose with that great advice, that takes us to the end of the show. Tell people where they can find out more about you, Eoin, and Pure Finance.
Yeah, my website is www.purefinance.ie. I'm also on LinkedIn, but my website's probably the best way to find me. Yeah.
All right. Well, a special thanks to our guest today, Eoin Wilson, for coming into the You and Your Business studio. Thanks all to Stephen on sound. The podcast today show available on 103.2 Dublin City FM at 1 o'clock next week. Thank you for your company, and please remember to join me, Alec Drew, again for another edition of You and Your Business.
Thanks a million, Alec. Appreciate it.
Yeah.